Hello and welcome. In this lecture video on page 295 of your course pack, and we'll be doing some quick check problems, okay? So what I want you to do is I want you to pause the lecture video and do these three quick check problems here on page 295. Do the ones on pages 296 and 297, okay? So go ahead and tackle those and then we'll review it together. Thanks so much. Hello and welcome back. So let's see how you did. So number 11 here on page 295, when partners invest in a partnership, their capital accounts are credited for the amount invested. That's true. Number 17, salary allowances are reported as salaries expense on a partnership income statement. No, they're not. Okay. Number 53, Collins and Farina are forming a partnership. Collins is investing in a building that has a market value of $80,000. It also carries a $56,000 mortgage, which is a note payable that will be assumed by the partnership. And Farina is investing $20,000 cash. The balance of Collins' capital will be what? So here's the journal entry: debit building, credit notes payable for the mortgage, and then the rest goes to capital, the $24,000. So the right answer is B. Okay. Let's look at number 58, which is a really good problem to make sure you understand. Shelby and Mortensen formed a partnership with their capital contributions of $300,000 and $400,000 respectively. Their partnership agreement calls for Shelby to receive a $60,000 per year salary, none for Mortensen because just assume zero because it doesn't say he gets a salary. So no, doesn't get anything. Also, each partner is to receive an interest allowance equal to 10% of the partner's beginning capital investments. The remaining income or loss is divided equally. Net income for the year is $135. Okay. So I set up my table because I love tables. So we set up our net income, and then we've got Shelby and Mortensen, and then the balance. There's our first income, $135. Shelby gets $60,000, Mortensen $0. That means the balance is $75,000. Then it's equal to 10% of their partner's beginning capital investments. Here's their capital investments, $300 and $400. So 10% of $300,000 is $30,000. 10% of $400,000 is $40,000. Add those two together gives us 70. From the 75 gives us 5,000 left over. Remaining income or loss is divided equally, 2,500 and 2,500. Then we get 92.5, 42.5 right there. B is the right answer. And then here is the journal entry, debit income summary, and then credit capital. Okay. Hope you got that one right. And again, that's a good one to make sure you understand. Let's look at number 61, the partnership agreement for Smith, Wesson, and Davis, a general partnership, provided that profits be shared between the partners in the ratio of their financial contributions. Smith contributed $100,000, Wesson contributed $60,000, and Davis contributed $20,000. In the partner's first year of operations, it incurred a loss of $210,000. What amount would be absorbed by Smith? So what we have to do is add this, this, and this. That's the total contributions because it says it's distributed on their ratio of financial contributions. So that means Smith, we take his or her 100,000 divided by the total of 180, and then Smith therefore gets 100,000 divided by 180 times 210. So this is the percentage of the total that Smith has times the loss of 210. So 116, 666, rounded up, 116, 667. Okay? B is the right answer. Let's look at number 51. B. Tanner contributed $14,000 in cash plus office equipment valued at $77,000 to the JT partnership. The journal entry is A. Debit cash, $14,000. Debit office equipment for the $7,000, and then credit capital for the summation of those two, $21,000. Okay? So I hope you got those right. I'm going to end this lecture video now, and then the next lecture video will address admission and withdrawal of partners. Thanks so much.